Welcome to Buying a Home. I'm your host, Rashawn Levin, Realtor with KW United in Virginia, Maryland, and DC. Today's agenda, we are going to talk about the different steps to buying a home and everything in between. Let's get started. I'm so excited for this session. So, about me, I have been in real estate for 2 decades. Almost a little over half of my business is for buyers, and the other 45% is for sellers. My office is in Alexandria and Kingstown, and here's my contact information. So let's get started. Steps to buying a home: pre approval, find a home. It's your escrow phase after you find a home, and the end is the closing where you get those keys. That's the most important part, and that's why you're here to learn. So your pre-approval, that's important. So what are all the nuances with that? So your lender is going to want to see how do you pay your bills, and how they see that is by looking at your credit profile with Experian, with Equifax, with TransUnion. And they are going to want to look at those scores. So they are going to want to see also, do you have any late payments? Are you paying your payments on time? What do those scores look like? Because there's a lot of different percentages based on, you know, a lot, do you have a lot of inquiries? What does the score look like? And what they're going to do is use the middle score of all those scores, and that's the FICO score, not the Vantage score. The Vantage score is what other credit check modelings use. So if you're using something like Credit Karma or something else, those are Vantage scores. So that's not the FICO score. That's not the score that they use. That will give you a general idea of what your credit looks like, but that is not what a lender is going to use. So keep that in mind. You can say, oh, well, my credit score says, I'm at a 740. That might not be the case according to the lender. So keep that in mind. So, what are the different types of loans? How are you going to finance this house? We can't all be fortunate to pay cash, so we had to get a loan. So, there is conventional. So, there is a myth out there. A lot of people think that they need 20% down to buy a home. That is not true. Though, if you have 20%, you may put that down or not. So, first time home buyer requirement, 3% down, though it is going to depend on your income limits. Also, depends on income. And if you're a repeat buyer, you only need 5% down. There's going to be private mortgage insurance on the loan, and minimum credit score is a 640. Loan limit is based on county. FHA is 3.5% down payment. You're going to have mortgage insurance. Minimum credit score is a 580. Loan limit is based on the county. If you are a veteran and using a VA loan, not Virginia, there is no down payment required. There is no PMI. Credit score as low as a 580, yes. No loan limit. And for USDA, you have to purchase in a rural area, and the address has to be looked up to make sure that it's eligible. And if it's eligible and you're eligible for the program, you can use this with no down payment. It's more PMI than was a little bit less than what a FHA would be. So it mirrors conventional for the mortgage insurance. Credit score as low as a 580. Loan limit is going to be based on county. And also for the down payment programs for conventional and USDA, there are income restrictions on those. So based on the county that you're purchasing in. So interest rates, so they fluctuate. They go up and down, sideways and backways. But what we're talking about here is the difference between the interest rate and the APR. So interest rate is interest rate, what they charge you for to actually use the percentage of your loan. And APR is the annual percentage rate of your loan. So if say for instance, your interest rate was 5%, annually is 5.99%. So that's the course of an annual basis. How much is it costing you to use the loan? Can't be changed. They will never be the same. That's just what it is. And interest rates are based on your credit profile and other factors as well. So if you have a higher credit score, your rate will be better, and your mortgage insurance premium will be better if you have a higher credit profile. But it's not necessarily required that you have better credit to purchase a home. You can still purchase. It might cost you more, but you can do it. So mortgage payment, what is included in this payment? It's like, oh, why is it so high? Okay, so your mortgage payment is going to be PITI. So what is PITI? So that's your principal, is for the P. The I is for the interest. T is for the taxes. I is for insurance. And if your loan requires that you have PMI or mortgage insurance premium, then that's going to be added to the PMI. And if you're purchasing in a homeowners association or condo association, some communities have both together. So all of those things added up is what your mortgage payment in the eyes of the lender looks like. Even though your HOA or condo fee is paid separately, they want to see what that is. So say for instance, the mortgage is with everything before the condo dues and HOA dues is say 2,000, just for easy math. And then when you add those two things, it's 4,000, not 4,000, 400. So now you're at 2,400. And say the maximum, this is why you have to have a great agent to assist with this. If you cannot go over 2,000, then you will not be able to purchase that house. So if the lender says, by no means can you go over 2,000, not even $1 more, period, because your ratios are tight or you just don't want to go over that. So that's what you need to decide. If you have a payment that you want to be at and you do not want to go over that, you got to have in your mind, okay, well, I'm going to be okay with that with HOAs. You got to think with everything, what is the maximum that you want to do? Not saying you have to spend that, but you got to be realistic. Now, if the lender said you cannot go over this, then you better not go over it because you will get denied and that's going to cause drama. So that's an issue. So you want it to be a peaceful experience. So this is why I'm trying to educate you so you learn. So moving on, first time home buyer. So a first time home buyer is somebody that is buying a property to own as their primary residence. So you're not going to be jumping around, you're not going to be renting it out and all that. You are also considered a first time home buyer again if you haven't owned a house in 3 years. So if you sold a house back in 2021, you are considered a first time home buyer again, even if you had even if you sold a home in 99. Doesn't matter. Right now you don't own a home, you're first time home buyer again. So that's good. So that means you're eligible for the programs. So let's talk about the programs. So down payment programs assistance. So in DC, there is DC Open Doors, and you have to have a minimum credit score of 640. Income restrictions. You do not have to be a first time home buyer to use this. You can be a repeat or first time home buyer. In Maryland, there's Maryland Mortgage Program. They have several programs and grants within this. Minimum credit score is a 640. Income restriction is based on the county. And depending on where you're purchasing, you may be eligible to be a repeat buyer, but it just depends on where it is. If it's in an eligible census tract and they're okay with that, then you may be allowed to. So speak to your loan officer or speak to your realtor about that. And for Virginia, lastly, Virginia Housing, formerly VHDA, credit score of a 640. Income restriction is based on the county. You have to be a first-time home buyer for this. They have several different programs. So they have a closing cost assistance program. They have a down payment assistance program. So they have several programs within Virginia Housing. And you actually have to take a class, home buyer education class. Pre-approval letter. This is the golden ticket that shows your good faith to the seller and to the listing agent that you are a strong candidate for this contract because your assets have been verified, your credit has been verified. These things have been verified. Now, by no means does a pre-approval letter means the lender is going to commit to lend to you, but they've done their upfront due diligence to say, okay, well, as of right now, you're good to go. We will state that you are eligible for this loan. But you have to have that because the seller's not even going to entertain your offer. It's like, oh, well, yes, I'm going to pay $500,000 for your house, but I can't prove that I can pay it. But you should let me, take your house off the market. No, that's not going to happen. And you want to make sure that you had a strong lender because the wrong lender will have you crying at night because if you pick the wrong person and they're not communicating your offer in a bidding war situation, it's not going to get accepted. So you want to have the right lender. I can tell you some stories about that. So getting pre-approved, what does that look like? So on the right-hand side of the screen, that is what a loan application looks like. So there's 9 pages that you have to fill out. Don't get alarmed. Your loan officer more than likely will have something that's online that will convert the data to these sheets. So you may not have to physically type everything in here. It's going to get there, but I just wanted you to kind of have an idea of what the document looks like. So you're going to need your driver's license, of course, and also check your driver's license and see when it expires because you will not be able to close with an expired driver's license. I mean, you can close with a passport. You need to have some valid identification to close. Also, you'll need your social security number, your current address, your housing history, where have you lived for the past 2 years, and who did you pay? So their landlord, property management company, who was the person that you paid. If you currently have a mortgage, they want to see the mortgage statement, who are you paying? At least to show them like 1 month, they may request that. Pay check stubs, W-2s for the last 2 years, federal tax returns. If you're self-employed, they're going to want all the schedules and your bank accounts statements for the last 2 months. So think of 2s, everything you need in 2 months, 2, 2, 2, 2. So agency. So you should have an agent, but I'm going to explain the different types of agents. So you have listing agents. So the listing agents represent the seller. They're the ones with the sign in the yard or no sign in the yard, that the lockbox. So they represent the seller. So their job is to be the seller's advocate. That's their role. So they have no they're not trying to by no means get you a deal. They're trying to get their clients a deal. So then you have the selling agents. Sometimes people get confused with the name of selling because that sounds like seller. But on paper, this is what they're called. So a buyer's agent is a selling agent. So you need to know that, or a selling broker. That's what it's called. And the buyer's agent represents the buyer. That's their advocate. They're trying to get them the best transaction experience as they can. It may not be a deal, but sometimes getting the deal is the deal. Just keep that in mind. It's like you might not be able to haggle over the price and all that, but sometimes just getting the home is the deal. That is the win. That's the win. Think of that. Like I got the house, I got it on my terms. This was the win that I won because it can be tough. So prepare yourself, as I always say, brace for impact because it can get very emotional. So now moving on to dual agents or dual agency. So that is when the same agent represents the buyer and the seller. So this person cannot be an advocate for either party. So they're just there I call it, like, think of the analogy, you're shuffling around paperwork. It's like, okay, well, here, you sign, you sign, you sign. But I can't give you any advice on what you should do or anything. I'm just here, and both parties agreed to make the transaction smoother or, in their eyes, easier. So some people opt that way, but you need to know what that means. Designated agency. So what that would be is if you had an agent at, let's say, 123 Real Estate, and the property that you wanted to purchase was 456 Main Street, and one no and 456 Main Street was listed by 123 Real Estate, and your agent also works there in the same office by the same broker. So that's what would be considered designated agency, because they're under the same broker umbrella. So that's what that is. Different agents representing their parties individually, but because the broker represents them all, that's what that is. So moving on, we got to find a home, or nothing happens without a home. So that's the most important part. Well, one of the parts. So area of choice, people, so consider this in you trying to narrow down where you want to be. So proximity to work, do you need to be close to work? If you don't need to be close to work, what does the home need to have in it to accommodate you working remotely? Do you need to be near a mass transit? Do you need to be near metro, VRE station, or some other sorts of transit? Entertainment, what do you like to do? Do you like to go out? Do you like to, you like to dine out? I'm like, what is your plans? You got to think about your lifestyle. What do you need to be near? And if you have children, do you need to be close to schools? Do you need a certain school rating? And where are you going to get those ratings? And what are you going to measure off of? But I always say this with schools. So don't just look at where your child's school is now. Think of the time frame where you're going to be in a few years. So, okay, if they're in elementary school now, if you plan on being in this house for 10 years, then they will be in high school at some point. So, what does that high school, what does that middle school look like, and what does that high school look like? Because if you're not moving in 10 years, that's the most important part. Elementary, that's important, but those later years are really important. So, you got to look at that. You got to look at it long term. And typically, if a school rating is not great now, it's probably not going to improve. It's usually going to get worse, typically. But that's my 2 cents on that. Let's move on. So, property showings. So, you can schedule a showing every day. If you have an agent, you can go on Sunday, you can go on Wednesday, you can go on Thursday. But the thing is, what you see online and what is actually available are two different things. So the agent's job is to verify that it's fully available. But of course, between the time you look at it and the time you decide that, oh, well, this is the house I want to write on, I see myself in it, are two different things. As you're driving from the property, the home could be taken off the market. So it does happen. So prepare yourself. As I said, brace for impact. So you need to understand that things can change very rapidly, like overnight, within minutes. But keep in mind, in the winter months, before 5 o'clock, it's recommended to look at homes prior to this time, because it's very difficult to look at addresses at night. It's like, oh, well, what address is it? And you don't want to park in somebody else's spot and get towed, because I would be upset if somebody parked in my spot and I've been working all day, like I'm trying to get rested once I get home and you're in my spot. So yes, I would tell you, but that's just me. And also, I mean, it's for a safety thing. I mean, you're not familiar with the area, you don't know. Could be a crack in the sidewalk and you fell down. So it's just a lot of crazy things that can happen. So go in the daytime. It's the reason why agents tell you that they want to go in the daytime. It's not that they don't want to see you at nights. It's just for safety precautions. And plus, you have to go see it in the daytime anyway. You're like, oh, I didn't notice that, because you couldn't see it. So go in the daytime. So existing homes versus new homes. Should you get a home that's already existing home is also called resale. Resale home or new home. So let's talk about existing homes first. So consider the age of the home. So 2010 or newer have a more modern design. They're going to have that open floor plan, open concept. Homes built before 2010 are going to have more traditional layouts. They're going to have closed walls from the kitchen to the family rooms, things like that. Pros, well, actually, this is technically not a pro, this is a con. So you possibly have a bidding war. Um, is less expensive than a new home. The cons also, um, you'll have lower earnest money requirements. A con could be the seller may want a rent back and you may not get closing cost assistance. So now, new home, it's new. So the major ticket items will not need to be replaced, such as the HVAC, roof, gutters, windows, electrical panels, etc. Pros, you're not going to have a bidding war. You pick lot 25, that's your lot. You put your money down, that's your house. I don't have to decide any of that. So that's your house. So as opposed to existing home, you write an offer, you're like, oh, well, did I get it? I don't know. You didn't get it, so you're moving on to the next house. So that's that. Pro also with a new home is builder incentives. So they could give you money for upgrades to the home. So instead of granite countertops, they'll say, okay, well, we'll let you upgrade to, quartz, vice versa. Instead of black appliances, we'll let you get stainless steel, whatever. So cons, there are lot premiums. So depending on where, even if you're buying a townhome, there's a lot involved. So it's like, well, not a lot, like a lot. It's a lot, like lot, space. So you want an in unit, interior unit. So an in unit is one lot, and then the interior unit is a different lot. So an in unit typically could range you between, 10 to 15,000 to be on the end, for example. You have a higher earnest money requirements. Typically, a builder wants 5 to 6% as earnest money to be held in escrow. And depending on the type of loan program you get, you may get some of that back or most of that back when you close. Or you may not get any of it back if you need it for closing. And it may be a longer wait time for delivery. So, if you're going today, you may not be able to be in your new home for 6-7 months because maybe they have a backlog on their delivery times. They're working on getting permits because if they don't have permits in the house, they're not building or they can't build legally without having the permit in place or the county will shut them down. And a new home is typically more expensive than an existing home. So, something to think about in your travels. You have to decide, well, do I want to go with an existing home or a new home? Weigh out the options. Because when you think about it, well, is it really different if you can get what you want and if you can afford it, get what you want? So, think about that. So, funds needed to buy a home, how much? So, this is just a guide. This isn't, etched in stone. But so you're going to need earnest money. So, we're going to read from left to right. So, description, estimated costs, and when is it due? So you have your earnest money deposit. So I'm talking about resale existing homes here. So you need 1% of the sales price. When is it due? It's due after the contract's accepted. Home inspection, radon, termite, they are due the day of inspection. And the costs of those are estimated there. Appraisal, up to $700. That is due when the appraisal is ordered by your lender. Credit report, that varies. You need to ask your lender about that. If you're purchasing a condo, you will need to pay for a condo questionnaire. Your lender is going to order that. It's due before the condo fee for the questionnaire is due when the condo questionnaire is ordered, and that is required if you're purchasing a condo. Down payment can be up to 20%, and that is due on closing day, and your closing cost is 3.5%, and that is due on closing day. So escrow. So we're in the escrow phase. So I want to talk about home ownership, like how you take title matters. So if you're purchasing by yourself, it's solo. So that's pretty simple. It's one owner. So where things not necessarily get complicated is when we move past with two people. So you can have what's called a joint tenant. So this is when two people own a home with right of survivorship. So that means if one person passes on, unfortunately, then the other person's interest passes on to the remaining person that's still there. Now, if you are married, then you would hold title by tenants by the entirety. And tenants in common is the final option for holding title. That's when two or more people have no right of survivorship. The interest of the property is determined by percentages. So you could say, okay, well, somebody has 30%, somebody has this percentage, and then somebody has this percentage. So that's their percentage of ownership in the property. So if one person passes on, then they split that person's percentage between the remaining people. And if there was no will, actually, no, take that back. If there's no will involved, if they don't have anything in place of how that's going to be, then it's actually those two people. If it was three people there, the two remaining people that survives would own the home with the heirs of the person that passed on. So it can get complicated, but just wanted to give you an overview of what that looks like. So you found the home you wanted to get. What's next? What do you need to submit the offer? So you remember when I said about that pre-approval letter? You need that before you go out to look at houses anyway, so you already have that. So with resale, I would say stay away from online lenders because they're not going to be as quick. Because I always say you should have the letter to the amount that you're actually purchasing. So say for instance you can get up to 800,000. So but the home you actually like that you want to consider writing an offer on is 750. But you don't really want them to know because you want to have a little bit of leverage. You don't want them to know that, oh, well, I really can go up to that much. But you want to see if you might be in a market that you say, oh, well, this house is overpriced and I'm just going to offer less. You know you can go up that high, but right now you say, oh, well, I want to offer 725. So then you get the updated letter from your lender and you submit it that way. So for a new home, you have to get an approval from the builder's lender. That's the requirement. You do not have to use their lender. So correction. Make sure you understand that. You don't have to use the builder's lender, but you do have to use the builder's lender if you want to use their incentives that they're giving you. So you can use what you want, but if you want to get their closing costs, if they're offering that, you will have to use their lender. But keep that in mind. But in the beginning, you have to get approved because they need to see that, you know, the letter that you have is authentic or whatever. They want to make sure that that's just part of their QC program, checks and balances. So earnest money deposit. So for resale, I would say up to 3% of the sales price to be competitive. You can do as low as 1%, but really it's the amount that the seller is willing to accept. So it could be 1% of the sales price, but to be competitive, 3 or more, basically whatever you can do. New homes is up to 6%. I had said that in the previous slide. So offer documents for resale. The contract is prepared by your buyer's agent, so you want to know what sales price you want to offer. Earnest money deposit, how much is that going to be? The contingencies, are you going to have a home inspection contingency? Like what does that look like? Closing date and the disclosures that are with the home, you have to review those and sign. And so in new homes, the contract is prepared by the builder sales representative. So you review it and then you sign it there. You can't make any changes. It is what it is. Basically, in a nutshell, that builder contract protects the builder. So know that. So you submitted an offer. What happens? You submitted it. Now what happens? So right now, picture your offer is with the seller. They're reviewing it. So one of three things can happen. They can accept it, which means they accept it as is. They're not making any changes. So first option, they accepted it. You're good to go. You're under contract. So they could say, well, I like your offer, but I'm not giving you my wash and dryer, and I need you to close sooner, or I need you to close later, or I need a rent back for 2 weeks. So that's what's considered a counter. So they like everything, but they have another condition that they need you to meet in order for it to be a contract. Or they can flat out reject it. It's like, closed for negotiations. No, we don't like your offer. It's too low. They don't really have to give an explanation. It just is no. They should. They should always counter, but it may not. And basically, if you're in a bidding war situation and you didn't get accepted, that's a rejection. So it's like, well, we accept another offer, so that's a rejection. So be aware of that. So what happens? You have what they responded to you. So if they accepted, congratulations. No additional negotiations are needed at this time. You're under contract. Marvelous. So, but they countered. So, well, maybe you really need that wash and dry, but I mean, do you want to let the deal go for wash and dry? You know, so you got to keep in mind that, it's all in negotiate. Everything is negotiable. But so you can counter the seller's counter offer if you want, or you can accept it. You say, oh, well, I can live with that. It's fine. I really like the house. It's fine. So, but keep in mind during these negotiations, the seller could get another offer that's better than yours and they can accept that. So keep that in mind. So don't take a long time to try to decide and do I really want to do this and all that, because another offer could come in that's better than yours. They don't have to tell you what it is, and they're like, you know what, I accepted another offer. So that's what it is. So until you get it back to them, and especially if you made changes to it, they can always get something else. Until everybody agrees to everything, you pretty much don't have anything. You have a possibility, is what you have. That's what I'm going to start calling that. Or rejection. Or you can say, well, if what happens if they rejected your offer? You could, if it was just a flat out rejection and they're not under contract with another buyer, you could say, well, I'd like my contract to be a backup offer. I mean, there are pros and cons to doing that. Or you can, you say, okay, well, thank you, and I want to, submit another contract because maybe your contract was too low. Or you say, well, I just want to move on. It wasn't meant to be. Let's move on. So that's it for that. So after the contract's accepted, what happens? So the key is in the distance. We almost can get it. It's almost there. So your earnest money is due. That's when the money is due. So then your contract documents are submitted. Home inspection is scheduled and then completed. You pay for your appraisal. You follow all the lender instructions. You follow all the real estate agents' instructions and guidance. You don't open any new credit. You don't change any jobs. That's it in a nutshell. Overview. So a contingency. So with a real estate contract, if a contract has a contingency, that means there is an additional negotiations or the contract can be voided depending on the wording. So let's talk about it. So what kind of contingencies can an offer have? You can have home inspection contingency. So you would need an inspection report, and negotiations are needed likely. Financing. So you need your financial commitment letter from the lender because that shows that they are fully committed to lend to you. And then you can release that. Your appraisal. So the value has to be at the sales price or higher. Or if it's too low, then additional negotiations will be needed. Third party approval. There may be a contingency that the seller has. Maybe it's a short sale. It could be probate or another special consideration. Maybe it's a bankruptcy and the court has to approve the sale. It could be a number of things, but that's like examples of where the third party approval has to be. So HOA and condo association document review, based on the state, there are going to be a number of days that you have to review. It's going to be a big packet. More than likely, it's not going to be a physical packet, so know that. So it's not going to be, they usually don't print them anymore. So it'll be digital so you can look at it, which, if you want to search, you can search PDFs now for certain documents that you want to see. But you want to check for violations and have your agent assist you with removing the violations, because if you don't remove them and you move in, now they're your problem. So if there's any problems basically with a house, you want to try to see it. at most the seller fixes all the problems because it's still their house. And if they want to sell it, then I want you to do this or I'm not going to buy it, basically. And home sales. So the seller could have a home, not a home sale contingency, but they may have a home of choice contingency. So they say, well, oh, that's not what this is, but there's another contingency that's not on the list. They may say, well, I accept your offer, but I need some time to find my next house because I don't want to be homeless. So I need 30 days to do that. And after that time, we will, in the contract, it'll say what happens. Or you have a home to sell and you say, oh, well, I can't buy your house until my house sells. That's going to be tough in the market that we're in right now, but that is possible that you could put it in the contract. I will say this, in a new home sale, you won't be able to do any of these contingencies at all. Just know that. So that's it for that. So underwriting, keep in mind, this is very, very, very important, that a pre-approval is not a commitment for a lender to lend any money to you. That's just a snapshot in time that says, based on the information you provided to them, that you look good on paper, but we still got to verify what you said. So until you get a clear to close and your final closing disclosure, you will not be able to close. So do not call the movers until you know for sure that you are moving on XYZ date. Until you get your keys. You can't move in until you get your keys. I don't care what they said. So until you close. So closing, we're at the end. So closing day, what to bring. This is like a little table of how, closings look. You'll have somebody at the head of the table and then on either side. It's very rare that you'll see a seller at settlement, but it's possible. It still happens. But a lot of times, people are digital now. Most of the time, sellers are not even local, so they've already signed, especially if it's, new construction. You'll never see the builder reps there. So, it's possible that you see the other side, but it's not. So what I would recommend that you do is get a list of questions, especially if it's resale, of things you want to know from the seller, because people know about things in their house, especially if it's a smart home, if they have different things in the home that, things that only they would know how to do, because people know how to work their devices. So I would say make a list of questions before settlement day so you can ask the seller to provide instructions on how to use blah, 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 especially if they have like a sprinkler system and, you want to have all that information. So your buyer agents will accompany you at closing. You want to bring your identification. Remember I said a non-expired license or passport, because you will not be able to close. I had this happen. This is a story of a client. This was many years ago, but the buyer's license had expired and we were not able to close. We closed, but they had to go. This was back in the day when you could actually go in DMV and get an appointment and get your things, but they had to basically spend all day to do that. And the title company had to stay open later to accommodate that. But check your license to make sure that it's not going to expire, because you don't want to have that, because then you're driving around with a license. So then that's another problem if you get pulled over. So, and then everybody that's purchasing the property must be present. So if it's, you're purchasing a home with someone else and they're not going to be available, they're going to be TDY on a work trip where they're going to be somewhere else, make sure you get a power of attorney and let your agent know and the mortgage company know. At least, I said 3 weeks, but sometimes you don't know that. At least 2 weeks in advance, because proper documentation has to be signed. And making sure that it's correct and that your lender is going to allow for attorney in fact or whatever. So you want to make sure that that's not an issue. Or you have to delay settlement when that person comes back in town. So, and then you'll need to bring a certified check or wire, but check with your title company on this, of how they will allow you to bring the money. Because sometimes lately I've noticed, and this was passed in 2023, that title companies only wanted you to wire it. and it's special instruction for how you wire things, and you want to verify things before you send the money, because once you send the money, it's gone. You can't get it back. So it's very important. So when in doubt, always ask. There's never a dumb question. I'd rather you ask the question than to be swindled out of some money or something because you didn't know. It's like, oh, I was too scared to ask. Don't ever be too scared to ask, especially when it's about your money. Okay? So now, home buying timeline. How long does it take? So your pre-approval phase is up to 3 days, depending on how fast you submit your documents and who you chose as a lender. Find a home, it could take up to 90 days. That's why I say star. So it depends on that. It could take longer depending on how picky you are too. So escrow to closing is up to 40 days depending on the type of loan you have, of what was in the contract. Your timeline is going to depend on your unique needs. The quickest home buying journey, I would say, is 3 weeks from start to close. And that's, you found a home, you did everything, closing, boom. So an escrow phase, the quickest I've seen is 2 weeks. So 14 days, you could, if you find a home today, you can close in 14 days. That's the quickest way. Now the other stages vary, but I mean, just so you know, you can close like literally in 2 weeks. They say like 12 days, pushing it, but it's possible. But if you want to close that quickly, I mean, you have to have everything the lender asks for quickly. It cannot be any delays at all. So I would recommend that you download everything, like create a folder in Google or do like Box account, and if the lender asks you for it, then you can upload it wherever you are. Like if you're at your work computer, you can do it wherever you are. So that's important. So also in a strong buyer's market, the find a home phase is longer because it's less inventory. Well, actually, it's more inventory. It's supposed to be flipped. Sorry. In a strong seller's market, find a home phase is shorter. Those are supposed to be reversed. So, next steps, schedule your buyer consultation with me. I'd love to talk to you about your home buying journey. And you can text me, you can email me, or you can scan this QR code on the screen. And if you're watching this webinar outside the DC metro area, I have a network of agents throughout the US that can assist you. Just let me know, and I can connect you with them. Make it a great day, and talk to you soon.